Petty Cash Funds by Tiger Lee, student number 129170035. What is petty cash? Petty cash is an amount of cash kept on hand to pay for minor expenditures. These minor expenditures include paying for postage and the purchase of miscellaneous office supplies such as pens, paper and folders. Now one might ask, how does petty cash work? Well, before petty cash is used, a petty cash fund must be established. When in use, a business can make payments from the fund, and as the fund decreases, it will need to be replenished. Thus, the petty cash fund is concerned with three main steps. 1. Establishing the fund. 2. Making payments from the fund. And 3. Replenishing the fund. Step 1. Establishing the fund. A petty cash fund is established by writing a cheque for the amount of the fund, cashing that cheque in, and placing the cash under the care of an employee assigned as the fund's custodian. Let's say you are a manager at Johnny T's accounting firm and want to establish a petty cash fund for $100. Suppose that it is the beginning of the financial year. Johnny T's accounting firm would record the following entries. On the 1st of July, you would debit petty cash for $100 and credit cash for $100. Note that when establishing the petty cash fund, that there is no change in assets. The money is simply being transferred from one asset account to another. Step 2. Making payment from the fund. After the fund has been established, payment can be made in two ways. Cash can be taken from the fund, or employees can be reimbursed from the fund for payments they have personally made. However, regardless of how payment is made, every purchase needs a receipt. For instance, let's say one of Johnny T's employees spent $50 on office supplies and $20 on postage. That employee would need to collect and keep the receipts from the purchases for future use. Now, as the cash in the fund decreases because of these payments, the fund must then be replenished. This leads us to our third step. Replenishing the fund. When replenishing the fund, Johnny T's accounting firm would need to provide a petty cash fund replenishment report indicating how much of the fund was used and the receipts obtained. Now, when the fund is replenished, the amount of cash needed for replenishment should equal the total amount of receipts. But what happens when they don't? Well, this is probably because the custodian did not collect all of the receipts or they had been given incorrect change. Well, how do we fix this? Simple. The discrepancy is charged to an account called cash over and short, which either has a debit or credit balance depending on the situation. It is used when Johnny T does his journal entries at the end of a month as shown. Now, as you can see, the cash over and short account is debited as the petty cash fund was short $2, and therefore there will be an increase in expenses as total debits must equal total credits, as assets equals liabilities plus equity.